Section 14 Part 2. Conventional versus government loans. As you've learned, the primary mortgage market is made up of commercial banks, credit unions, and other institutions that lend directly to the consumer. These primary lenders generate the loans, then package and sell them on the secondary market. Loans made on the primary market can be either conventional loans or government loans. Conventional loans. Conventional lenders offer a broad range of loan products that vary in length and carry terms that do not include any insurance or guarantee from a federal agency. Rarely, originators will hold on to and service a conventional loan from start to finish. Usually, though, conventional loans are bundled together and sold on the secondary mortgage market. At one time, buyers had to make up to a 20% to 25% down payment to qualify for a conventional loan. In today's market, few buyers come to the transaction with that kind of money saved. Buyers may get a conventional mortgage for as little as 3% down. This smaller down payment may mean that the lender will require private mortgage insurance, PMI. PMI covers the lender for the difference between the buyer's actual down payment and what the lender would like to see, in case the buyer defaults. Some mortgage programs permit a lower down payment with no required mortgage insurance. These programs may carry higher interest rates, though, so buyers must compare monthly payment amounts, interest rates, and total cost over the life of the loan. Conforming versus non-conforming loans. Conventional loans are called conforming when they meet Fannie Mae and Freddie Mac guidelines. Both Fannie Mae, the Federal National Mortgage Association, or FNMA, and Freddie Mac, the Federal Home Loan Mortgage Corporation, or FHLMC, are government-sponsored enterprises, GSEs. During the financial crisis of 2007 and 2008, the federal government stepped in to keep these corporations afloat. So while they're not owned by the government, they're backed by the federal government to protect them against failure. Even though the government has established some controls over Fannie Mae and Freddie Mac, they're still publicly traded companies. Fannie Mae and Freddie Mac work with both the primary and secondary markets, but mostly operate within the secondary market, acting as a sort of link between banks, the government, and Wall Street. They buy thousands of mortgages from banks and other lenders, repackage them into mortgage-backed securities, then sell them on the secondary market. By purchasing loans from primary lenders, those lenders are then able to take that money and make more loans. Loans that don't meet Fannie Mae or Freddie Mac guidelines are called non-conforming loans. Because the loans don't conform to FNMA or FHLMC guidelines, lenders typically carry a higher risk and make up for it by charging higher interest rates. Government loans. Government loans include participation from a federal agency as an originating, insuring, or guaranteeing party. The two most common types of government loans are Federal Housing Administration, FHA, insured, and U.S. Department of Veterans Affairs, VA, guaranteed loans. Other government loans include loans provided by the U.S. Department of Agriculture, USDA, or through state or local homebuyer programs. A buyer can put down as little as 3.5% for an FHA loan, and VA loans don't require a down payment or mortgage insurance, plus there's no prepayment penalty. The reason lenders don't mind the lower down payment is that the gap in the down payment is covered by the governmental entity. It's either insured by the FHA or guaranteed by the VA. Not having to plunk down tens of thousands of dollars makes government loans attractive to a lot of buyers, especially first-time homebuyers, who won't have equity from a previous home to access. Borrowers with lower credit scores, minimum 500, with 580 required to secure a 3.5% down payment, may qualify for an FHA loan when they wouldn't qualify for a conventional or VA loan, which, depending on lender requirements, may require a score of at least 620. Because of the ultra-low down payment and lower credit requirements with FHA loans, and therefore the increased risk to the lender and the FHA buyers have to pay a mortgage insurance premium, MIP, which is similar to PMI, but unique to FHA loans. A word about mortgage insurance. The primary difference between the mortgage insurance for a conventional loan versus an FHA loan is that the borrower pays MIP for the entire life of the FHA loan. PMI on a conventional loan can be eliminated when the value of the property reaches at least 80% of the loan balance or when the loan reaches its midlife point. Borrowers must carefully weigh the differences between loan products, including the cost of mortgage insurance over the loan's life, when evaluating which loan product is best for them. Conforming versus non-conforming loans. Conforming loans. Meet all qualifying guidelines set by Fannie Mae and Freddie Mac, which include loan amount, down payment requirements, loan-to-value ratio, housing debt-to-income and/or total debt-to-income ratios, non-conforming loans. Don't meet all qualifying guidelines set by Fannie Mae and Freddie Mac. Frequently are jumbo loans, above the loan limit for government-backed loans. How construction loans work. A construction loan provides short-term financing for the purpose of constructing improvements on vacant land, or on land that has improvements but will soon have more. In order to obtain a construction loan, the borrower has to submit the plans and specifications for the planned improvements, as well as information on the property on which the improvement will be built. Construction loans are then based on the builder's plans for improvements and on an appraisal. The entire loan is not funded all at once. Think about it, why would a lender lend $200,000 on vacant land worth $75,000, even if a $300,000 building is planned? The builder could simply abscond with the loan proceeds, or decide not to build, and the lender would be left with a $75,000 piece of land and be $125,000 in the hole. So instead the lender will disperse the loan proceeds in portions, according to completion of various phases of the construction. This gives the builder enough money to complete the various stages, pay for materials, pay subcontractors, but doesn't put excess money in the builder's pocket. And the lender charges interest only on the funds actually disbursed. When the improvement is complete, the lender will make a final inspection and fund the remainder of the loan. The loan is then converted from a short-term loan into permanent long-term financing, or, if a buyer has been found, it will be replaced by financing obtained by the buyer. When converting a short-term construction loan to permanent, 30-year, financing, these are called takeout loans or end loans. Because of the high interest rate on short-term loans, permanent financing is nearly always required, otherwise the borrower would not be able to afford the loan. What's to prevent a builder from running off with the first installment of a construction loan? Well, lenders require them to be bonded. This bond is made payable to the lender if the builder doesn't pay for any reason. This allows the lender to find a new builder to complete the construction and then sell the improved property, recouping its investment.